Are you thinking about buying a home but heard about private mortgage insurance or PMI? Well, if you have, watch this short video to learn all about private mortgage insurance. Hi, this is Blake Davenport with the Davenport Group. I'm a local realtor in the DC metro area, here to share with you short and simple real estate tips. Today we're going to be talking about private mortgage insurance, or as it's often referred to as PMI. So what is private mortgage insurance? So it's extra insurance that a lender requires when a borrower puts less than 20% down, which is often the case in the DC metro area because homes are so expensive. So because you're not secure a borrower as somebody who can put 20% down, the lender requires that you get private mortgage insurance or extra insurance to protect in case you default, because you're more likely to default in their eyes because you're not putting as much money down. So it's an extra monthly fee. Typically it's around $100 or so added on to the monthly payment, which stays with the property until you hit 20%. You can ask for it to go away instantly at 20%, but it goes away automatically at 22%. So that's a key distinction, that you have to ask for it to go away once you reach an equity of 20%, or I should say equity share of 20%. So pretty much it's just extra insurance that you have to pay when you're putting less than 20% down. A common myth about private mortgage insurance is that you have to get it if you put less than 20% down. That could be further from the truth. With a lot of our clients, they actually put less than 20% down and still don't pay private mortgage insurance. How do you do that? Well, there's a number of ways. One, say you're offered an interest rate, and interest rates are really low right now, offered an interest rate of 3%. Well, with PMI, say of $100 a month, well, you can get a slightly higher interest rate and avoid it altogether. So maybe you're able to get it for 3.375 or 3.5% or 3.25, just depends on the situation. And your monthly payment actually might be cheaper getting a slightly higher rate without PMI versus a lower rate with PMI. It's just, you really have to kind of crunch the numbers and see the difference. One of the reasons why you would keep a lower rate with PMI is if you plan on owning the property for a long time, because at some point, it depends, it could be 8 years, it could be 5 years, it could be 15 years. At some point, it's going to be better to save more money in the long run by having a lower rate over the long time versus a slightly higher rate without the PMI, because the PMI will go away eventually, but depending upon how much you're putting down, it could take several years to get it to go away. So it's really a break-even point, but for most people don't plan on staying in a home longer than, say, 5 to 7 years. So it actually makes sense to get a slightly higher interest rate and to avoid it altogether. So what I just described is called lender-paid mortgage insurance. Another way that you can get the PMI to go away is to pay it up front. So depending upon the size of the loan and how much you're putting down, they can charge you an upfront PMI payment at closing. So instead of maybe saying making $100 a month for the next 6 years, you can prepay at closing $4,000 and it automatically goes away. I don't typically suggest this. Some people do this because they want to keep their monthly payment as low as possible. However, we live in an area which has a ton of appreciation. I've had a lot of clients that say they only put 10% down. We're paying PMI, but then their place appreciated like $50,000 within the last 2 years, and then they refinance, and when they refinance, they actually had 20% equity because of the appreciation. The PMI went away altogether. So I would avoid paying the PMI up front unless you want to keep your monthly payment as low as possible, because since your interest rates are so low, it's really not worth to spend the $4,000 or $5,000. I mean, it could be even greater than that to get the PMI to go away. You'd probably in this time rather have the money to do stuff, make fixes. If anything happens medically, it's better to have that money, in my opinion. So that's pretty much it. What PMI is it's pretty simple. It's just extra insurance that's added to a loan when you're putting less than 20% down. There are ways to avoid it, like I said, by getting a slightly higher rate or prepaying all of the insurance, I should say, at closing. It just really, you have to determine how long you're going to be in the property and what that break-even point is. That's something that I can help you with. I love kind of crunching the numbers and figuring out what's the best solution possible. Also know that PMI, the mortgage insurance varies by lender, and that's something that you can negotiate. I've had lenders quote $120 per month and another lender quote $67, and then they were able to match it. So that's another aspect that you can kind of lower because it's not standard across the board. It's just whoever they reach out to provide the insurance. So now you know about private mortgage insurance. If you like this video, please click the like icon. If you have a comment or a question, comment below. We'd love to hear from you. Also, click the subscribe button or the bell icon to be notified of our next video. But thanks again for checking out this real estate tip on private mortgage insurance.
Let's go.